Imagine walking through a home where the seller knows cash is on the table. The negotiation changes dramatically. All cash offers give buyers the ultimate leverage. But why are these deals surging now? And what's the hidden impact on the rest of the housing market? Who's behind the cash takeover? What kind of buyer walks into a luxury home listing and casually offers millions of dollars in cash? These aren't your standard buyers with a pre-approved mortgage and a 20% down payment in hand. There's something else entirely. At the top of the list, you have ultra-wealthy individuals, from old money families to hedge fund managers, for whom liquidity isn't just a perk, it's a lifestyle. Then there are tech executives, the kind cashing in on IPO windfalls or bonuses so massive they resemble lottery winnings. And let's not forget foreign buyers, many of whom see US real estate as a safe, stable place to preserve wealth. Together, they're building a cash empire in the luxury housing market, changing the rules of the game. Let's talk about their motivations. First off, you've got privacy. For the uber wealthy, loans often require opening financial books, something they're not always eager to do. With cash, there's no underwriting process for lenders to comb through. Privacy doesn't just mean discretion, it also avoids paperwork and time delays. Handing over cash guarantees a smoother, faster process, which is especially valuable if they're targeting a hot property others have their eyes on. Leverage is another massive factor. Sellers, especially those holding luxury properties, see cash as king. A cash buyer poses fewer risks. No financing contingencies, no chance that the bank pulls the plug at the 11th hour, and a significantly quicker path to an actual closing. In a market where competition often hinges on who can close the deal fastest and with the least hassle, cash buyers come out on top. It's not just that they have the funds. It's the confidence their offers inspire that gives them the edge. But the why isn't only about convenience. It's often strategic. Consider this. Tech executives frequently amass vast amounts of wealth through stock options. When markets peak, or better yet, when their companies go public, they've got a perfect opportunity to liquidate. For instance, in areas like Silicon Valley, it's not uncommon to see someone skip traditional financing altogether after cashing out an enormous tech windfall. These aren't impulse buys. They're calculated plays to secure property as an appreciating asset, a hedge against future uncertainties. Meanwhile, foreign buyers bring an entirely different motivation to the table. For many, purchasing US real estate is less about the property itself and more about stability. Wealthy individuals from countries facing currency instability or political risks, think parts of Asia, the Middle East, or South America, see American homes as a safe haven. Miami is a famous hotspot for this, with luxury beachfront condos bought in cash by buyers who want to safeguard their investments in a relatively secure and predictable market. Similarly, the Hamptons on Long Island have become a playground for anyone looking to diversify their global asset portfolio. And this isn't just anecdotal. There's data to back it up. Currently, around 40% of luxury home sales are being made with cash, a figure that's grown steadily in recent years. Compare that to 2018, when only about 28% of high-end transactions came with a full cash offer. As financing has become less attractive, and let's face it, much more complicated, it's no surprise we've seen this shift. Areas like Los Angeles, Beverly Hills, and New York City's ritzy Upper East Side aren't just hosting cash buyers, they're catering to them. These regions report significantly higher percentages of cash sales compared to the national average. The highly competitive nature of these markets means sellers often expect cash, which in turn makes it even harder for finance buyers to compete. But what's truly fascinating is the psychology of these buyers. For example, privacy isn't always about keeping wealth hidden. It can also be a public flex. Imagine strolling into a negotiation without needing to worry about bank approval. It's a power move. And if you think this is limited to mansions and multi-million-dollar investments, think again. In markets like Austin, booming from the tech influx. Or Miami, benefiting from international money flow. Cash offers are surfacing in properties just below the luxury threshold. It's a phenomenon reaching beyond the ultra-exclusive zip codes, affecting more buyers and sellers than you might first expect. At the same time, there's a stark contrast between these elite cash players and average home buyers. For many, especially middle-class families, rising mortgage rates are creating a significant affordability barrier. Imagine trying to lock in a loan in today's market only to compete with a buyer holding a briefcase full of cash, figuratively speaking. The result? A widening gap between those with immediate purchasing power and those stuck facing barriers to entry. What's manageable for the elite becomes borderline impossible for others simply trying to climb onto the housing ladder. Tech hubs like Seattle and San Francisco shine a light on this contrast all too well. Homes in these areas, flooded with tech money, are snapped up within days, and frequently by buyers waiving contingencies altogether. Sellers know these buyers are serious. They don't require approval processes or appraisals that could derail the deal. Contrast that with an average buyer facing weeks of waiting, pre-approval rechecks, and a grueling closing timeline. To say it's an uneven playing field is an understatement. What does this all boil down to? Buyers aren't just navigating a real estate market. They're navigating an entirely different set of rules when cash comes into play. And the more those rules favor cash, the more the market itself changes. Sellers grow accustomed to cash offers and begin prioritizing them outright. Real estate agents pivot toward finding buyers who can pay up front, while financed bidders struggle to break through the noise. The effect ripples outward, making competition more intense and negotiations more cutthroat. So ultimately, cash buyers aren't just purchasing homes. They're shifting the very dynamics of how luxury real estate deals are made. The landscape is evolving, shaped by the preferences and priorities of those with unmatched liquidity. But this trend isn't just a random phenomenon. Something is fueling it. Why is this happening now? And how are broader economic conditions influencing this wave of cash takeovers in real estate? That's where things get even more interesting. Why cash is king in 2025? Rising interest rates have completely reshaped the way buyers are approaching the housing market, especially at the luxury end. For years, even the wealthy weren't shy about taking out mortgages. They could invest their capital elsewhere and let low interest rates do the heavy lifting. But now, the numbers tell a different story. With the average 30-year fixed-rate mortgage climbing to 6.82% by 2025, according to Bankrate, borrowing has become a financial weight instead of a tool. Even shorter 15-year fixed-rate loans, often favored by high-income buyers looking to pay off homes faster, are sitting at 6.13%. That's a far cry from the days of historically low rates, and it's made cash deals much more attractive, even for those who could easily qualify for a mortgage. For buyers with the means, avoiding financing is about more than just convenience. It's a way to sidestep the rising costs of borrowing completely. Let's break this down. Say someone's looking at a $1 million home. If they're financing that property, closing costs alone could eat up $30,000. Not to mention appraisal fees and other charges tied to securing a loan. Cash buyers skip all of that. But the real savings come in avoiding interest payments. A $1 million loan at 4% can rack up more than $700,000 in interest over 30 years. Now adjust that to today's higher rates, and the cost skyrockets. For buyers who can afford to pay the full amount up front, it's not just simpler, it's smarter. High-end markets have felt these effects firsthand. In places like New York City, where property values regularly exceed $5 million, the combination of rising rates and stricter lending standards has slowed the pace of mortgage-funded deals. Sellers face longer timelines and, in some cases, deals that fall apart because financing doesn't come through. Compare that to cash buyers, who are able to close in as little as 5 days. That predictability makes all the difference, especially in a city like New York, where timing can make or break a sale. For realtors too, cash offers mean fewer setbacks and greater certainty that the deal will conclude without hiccups. It's no wonder sellers are increasingly favoring these buyers. This growing reliance on cash has also sharpened the trade-offs between borrowing and paying outright. On the surface, financing might seem like the flexible option. Why tie up millions of dollars in real estate when you can pay over time and use the rest of your wealth elsewhere? But at today's rates, that strategy loses its appeal. What you end up paying in interest can easily outstrip the returns you'd earn from investing that same money elsewhere. And for the wealthy, particularly those coming from tech or finance, that's enough reason to avoid loans altogether. The simple math of rising rates means cash isn't just a convenience anymore. It's a necessary competitive edge. Negotiation is where cash buyers really shine. Sellers tend to prioritize offers that come with fewer contingencies. A mortgage-backed offer has to survive underwriting, appraisals, and lender approvals, and each step carries the risk of delay or rejection. In contrast, cash doesn't come with those strings. Instead, it's quick, clean, and certain. This appeal has grown even stronger in today's uncertain climate. Sellers are navigating a market where buyers dependent on financing could buckle under shifting rates or struggle to secure approval as banks tighten lending requirements. It's a stressful environment for anyone who just wants to offload their property quickly, and cash buyers are the solution many turn to. The ability to outmaneuver competitors is another key advantage. Imagine a bidding war. Two buyers are interested in the same property, but one can pay in cash while the other needs financing. The cash buyer has an edge, not only because they reduce the seller's risk, but also because they might offer a faster timeline for closing without extra steps like an appraisal. In some cases, that certainty allows cash buyers to negotiate a lower price. Sellers know they won't face delays or see the deal fall apart at the last moment, so they might accept slightly less just to get the assurance of a completed sale. Of course, this trend hasn't arisen in isolation. It's deeply tied to broader economic shifts. The rise in interest rates hasn't just made mortgages more expensive, it's also created a ripple effect across the entire market, affecting how homes are bought and sold. Cash offers now dominate in markets like Los Angeles, Miami, and Austin, where the stakes are higher and competition stiffer. In Miami alone, a city long fueled by international wealth, cash deals continue to account for a massive share of luxury sales. The appeal is mutual. Buyers benefit from speed and savings, while sellers get to skip the uncertainty of financing deals. But what it also does is create a stark divide between those who can participate in this cash-heavy market and those who cannot. For everyday buyers who rely on loans to secure home purchases, the impact of these cash deals is significant. Sellers who've grown accustomed to cash offers may become reluctant to negotiate with financed buyers. Even if they consider loan-backed offers, the long closing process and added risks make those deals less appealing. In competitive areas, financed buyers often find themselves sidelined, losing out to deep-pocketed buyers who can swoop in without contingencies. The result? An even tighter squeeze on affordability for those who don't have the resources to go all cash. It's not all about individual transactions either. The broader market feels the strain when cash takes over. Sellers may hold out longer for cash bids, slowing inventory turnover and creating barriers for financed buyers. For neighborhoods experiencing an influx of cash offers, the ripple effect can drive up surrounding prices, making those areas even less accessible. Over time, the growing prominence of cash transactions could shift the way real estate operates altogether, raising the stakes in already competitive markets. At its core, what we're seeing now is a shift in strategy. Cash isn't just a means of payment, It's a tool being wielded to gain an edge in a market that's increasingly difficult to navigate. And as the gap between cash-rich buyers and those relying on financing widens, it calls into question how sustainable this trend is. Will this pattern keep gaining momentum, or is it simply a reaction to the current economic climate? The way the market has evolved suggests this isn't just about interest rates. It's a reflection of larger changes in wealth and how it flows through the economy. So if cash is now the ultimate bargaining chip, what's the cost of its dominance? The answers lie in how this trend reshapes not just prices, but the entire playing field for buyers and sellers alike. The spotlight shifts next to the ripple effects this cash-first mentality is creating throughout the housing market. How far does its influence reach? And who's left behind? The ripple effect on the housing market. When luxury buyers start making cash offers, the effects quickly spread beyond the luxury market itself. It's not just high-end real estate feeling the shift. This trend is reshaping affordability and competition in ways that ripple through the housing market as a whole. Let's start with who wins and who struggles in this new reality. Cash buyers have clear advantages. They can close deals instantly, often cutting out contingencies and delivering a level of certainty sellers crave. But for financed buyers, the landscape can feel both frustrating and unforgiving. Competing against someone who doesn't need a loan approval or appraisal often means losing out entirely, no matter how strong your offer is. Otherwise, consider what happens in highly competitive areas. Markets like Austin or Miami are dominated by buyers who can pay up front, largely because of the strong tech presence in Austin and the influx of foreign wealth in Miami. In these markets, cash buyers not only win more often, but also drive up prices. Sellers, naturally, gravitate toward offers that remove uncertainty. Cash means there's no chance of financing falling through or long delays for appraisals. As a result, the pressure pushes many finance buyers out of contention altogether. For first-time homebuyers or middle-class families saving for a down payment, this creates an enormous barrier to entry. The trend has also started to influence sellers. Those putting homes on the market are now favoring cash offers, not just in the luxury space, but in mid-tier markets as well. It's no longer just about commanding the highest price, but also about simplifying the transaction. The growing appeal of cash means sellers are now less willing to even entertain offers contingent on mortgage approval. In today's uncertain economic landscape, where rising interest rates make the housing market more unpredictable, sellers are seeking security above all else. And cash buyers provide that on a silver platter. One of the most immediate results has been a squeeze on affordability. When cash buyers dominate a market, they pull prices higher, often above what the average buyer with a pre-approved loan can manage. In areas with heightened competition, it's common for homes to sell at, or even above, asking price, a reflection of the strong demand fueled in part by cash-rich buyers. For example, in the luxury segment, homes often sell for 100% of the asking price or more, according to the most recent market data. While that might not come as a surprise in affluent neighborhoods, it signals troubling ripple effects for adjacent markets. As luxury prices rise, so do neighboring mid-level and entry-level markets, pricing out many would-be buyers. But affordability isn't the only challenge. Supply is another growing issue. Cash offers are advantageous for individual sellers, but as these transactions increase, they inadvertently limit the flow of available homes in the broader market. Here's how. Sellers who cash out quickly at a premium price may leave the market without relisting another property, particularly if they're downsizing, relocating overseas, or holding an investment property strictly to pocket the gains. The result is less inventory for the average buyer, especially those relying on financing. This reduced supply tightens the housing market further, making prices rise even faster, which only reinforces the appeal of cash in future transactions. Regional markets highlight the extent of this trend. In Florida, for instance, the prevalence of international buyers who can pay in cash has led to significant price hikes in cities like Miami. The rapid turnover of properties to cash buyers leaves local, financed buyers in the dust. Meanwhile, in tech-heavy hubs like San Francisco and Seattle, where professional stock compensation often funds real estate purchases, the high frequency of cash offers makes it nearly impossible for traditional mortgage-backed offers to compete. These are clear examples of how concentrated wealth in specific regions drives pricing patterns that impact everyone living there, whether they're buying, renting, or simply trying to stay afloat. It doesn't stop at competition and supply. There's also the issue of who really controls the transaction process. The more commonplace cash deals become, the more the rules of engagement shift in favor of buyers with deep pockets. For instance, cash buyers often have greater freedom to negotiate, not only speeding up offer timelines, but sometimes securing homes at slightly lower prices due to their ability to close quickly and without contingencies. Sellers love this kind of certainty in an uncertain market. Over time, these preferences create an uneven playing field where buyers dependent on financing are pushed further to the margins. Let's not overlook how this alters the buyer experience as well. For those trying to secure a home with a mortgage, the process is already complicated. Pre-approvals, credit checks, and lengthy underwriting timelines all add to the stress. Now, imagine going through all those steps only to lose repeatedly to cash offers. The frustration builds, particularly for financed buyers who see homeownership as increasingly out of reach in markets where cash dominates. Even property types feel the ripple. Luxury homes see this most clearly, but the trend is spreading to single-family homes in hotter suburban areas. For instance, it's no longer uncommon for buyers in places like Dallas or Charlotte to forgo loans altogether, opting instead to make aggressive cash offers on properties just under the luxury threshold. Once this mindset takes hold, it sets a new standard for how deals are done, even in places traditionally reliant on mortgage-heavy transactions. What it all boils down to is a fundamental rebalancing of power in the market. Cash buyers now shape not only the luxury housing market, but also how homes are sold, how sellers value offers, and how accessible homeownership is for the average buyer. And while this trend may feel like it's mostly a top-tier issue, it's trickling down in ways that redefine real estate for everyone. Markets dependent on financing are becoming increasingly fractured, as buyers relying on loans find themselves boxed out of neighborhoods they could have afforded just a few years ago. But here's the bigger question. Is this permanent? As cash offers continue to dominate, are we seeing real estate transform into an economy where financing buyers are permanently sidelined? Or is this a temporary reaction to rising interest rates and current market instability? It's not just about who's buying, it's about how the housing market itself evolves in response to these changing dynamics. The answers could point to long-term shifts in affordability, accessibility, and the strategies buyers will need to navigate in the years ahead. And that's where the real uncertainty lies. A temporary trend or permanent shift? Is the current cash-heavy trend in luxury real estate just a reaction to short-term factors? Or are we witnessing a permanent shift in how homes at the top end of the market are bought and sold? The answer lies somewhere between the unpredictable swings of the economy and deeper, long-term changes in the way wealth is managed. Rising interest rates and stock market volatility have clearly nudged many high-end buyers toward cash deals as a way to hedge against risk. But other factors like the growing influence of generational wealth transfers and the rise of branded residences hint that cash dominance could remain integral to the market's DNA. To start, let's look at what's driving the trend right now. Economic uncertainty has put cash buyers in a stronger position, particularly in an environment where mortgage costs don't make sense for even the wealthiest buyers. With rates now hovering near 6.8% for a 30-year fixed mortgage, borrowing large sums has become less attractive and, for some, downright impractical. This shift has encouraged affluent buyers to sidestep financing entirely, choosing instead to close deals quickly with cash. The Coldwell banker Takeover and their 2025 mid-year report backs this up, showing that more than half of luxury property specialists noted an increase in cash purchases among their clients. When borrowing doesn't make financial sense, why do it? High net worth buyers have also become more cautious about their investments in recent years. Stock market instability, combined with global political uncertainty, has made U.S. real estate an increasingly popular choice for wealth preservation. However, that doesn't mean these buyers are throwing their money at just any property. According to the same report, these buyers are eyeing homes that promise long-term value, whether through tax advantages, location, or specific features that give them investment potential. In other words, wealthy buyers are making strategic moves, not impulsive ones. Now, consider the growing role of generational wealth in real estate. Gen X buyers, those aged 44 to 59, are beginning to redefine who dominates the luxury market. Fueled by what's often called the silver tsunami, a massive transfer of wealth from baby boomer and silent generation parents, Gen Xers have seen their influence grow by 10% over the past 5 years, making them the fastest growing demographic of luxury homeowners. This influx of inherited money could sustain a preference for cash purchases, as these buyers use their new financial firepower to secure premium homes without the complications of financing. Then there's the rise of branded residences, properties tied to globally recognized luxury brands like Four Seasons, Baccarat, and Amen. These developments cater heavily to cash buyers, offering not just high-end homes, but curated lifestyles. In markets such as Miami and New York, where competition is fierce, these properties are becoming increasingly popular. According to Vertical Development's CEO Fernando de Núñez y Lugones, branded residences will only expand in prominence as developers lean into the branding as not just a design choice, but as a competitive tool. For buyers willing to pay a premium for exclusivity, a recognizable brand adds another layer of assurance to their investment. This premium, combined with tax advantages in certain states, often positions cash buyers as the primary audience for these developments. But here's where things get debatable. During periods of economic stability, financing tends to reassert itself as an appealing option. Some experts believe that as interest rates stabilize or even drop slightly, the current cash-driven trend could begin to wane. When borrowing becomes less costly, the opportunity cost of using liquid wealth to purchase real estate goes back up. Wealthy individuals with significant assets and investments might find it worth financing luxury properties to free up cash for returns elsewhere. It's a pattern we've seen before, especially during periods of low inflation and high market performance. However, others argue that this trend might not be as temporary as it seems. There's logic to the idea that the ultra-wealthy will continue to favor cash in a world where economic disruptions feel less like temporary hiccups and more like routine occurrences. Global economic instability has become a recurring theme, with wealthy individuals hedging against the volatility of currencies and markets by investing in tangible, long-term assets like real estate. Combined with the rise of smart buyers, focused more on financial strategy than indulgence, the market could be shifting in favor of a more cash-heavy environment for good. One thing to watch for is whether new financing models emerge as a counterbalance to these trends. It's possible that innovations in lending could make borrowing more appealing, even in a high-rate environment. For example, specialized luxury home loans or hybrid financing options geared specifically toward high-net-worth individuals may lure some buyers back into the financing fold. Additionally, shifts in buyer preferences could also shake up the market. Factors like remote work and changing lifestyle priorities might lead buyers to focus less on central urban luxury markets, broadening the scope of options and potentially lessening the prominence of all-cash deals in hotspots like Manhattan or Miami. Ultimately, whether the cash-first approach becomes a fixture or not, it reflects deeper transformations in how wealth flows through the real estate market. The growing role of generational wealth, branded residences, and investment-minded purchases suggests that the ultra-wealthy are thinking not just about homes, but about long-term stability and returns. While interest rates and stock market performance will certainly play their role, they're just one part of a much larger picture. The big takeaway? Cash purchases might seem like a byproduct of short-term economic shifts, but they're underpinned by broader forces that extend far beyond today's market conditions. Whether you're a potential buyer or simply watching from the sidelines, the impact of these market changes is hard to ignore. Real estate isn't just reacting to the times, it's evolving. And the question now is, how will these trends continue to shape opportunities, obstacles, and strategies as we move forward? Cash buying isn't just about sidestepping high interest rates. It's a window into how wealth is reshaping the housing market. This trend reflects a broader financial shift, where economic uncertainty and rising borrowing costs push well-off buyers to rely on liquidity rather than traditional loans. The question now is, how will you navigate a market where cash increasingly dominates? Whether you're an investor, buyer, or simply watching from the sidelines, understanding this shift is crucial. And as new trends emerge, the trajectory of real estate will continue to evolve in unexpected ways. So how will you prepare for what's next?